moving on to the panel discussion 1. So yes, the topic is about co-lending, an emerging trend in finance. The moderator of this panel discussion will be Mr. Venkatesh Kannapan, MD and CEO, Aham Housing Finance. Please put our hands together to have him on the stage, please. And the panelists for this session will be Mr. Krishna, Swami, CTO, Aptus Value Housing Finance. Please put our hands together to have him. Up next, I would invite on the stage Mr. Ramesh, Kumar, ACMD, Laraksha Impact Finance. And next, I would request Mr. Vivek, Kannan, COO, Hinduja Housing Finance to kindly join on the stage for the panel discussion. Up next, I would request Mr. Mukesh, Bubna, Founder and CEO, Monexo to kindly join. Up next, we request Mr. Amit Mandanya, Executive Vice President, Partnership-Based Lending, Northern Arc to kindly join. So they'll be talking, the focal points of this panel discussion will be API integration, interoperability, digital identity verification, scoring models and analytics, automation and workflow management. Over to the panel.
First of all, good morning to all, and thanks to the organizers. And I've been part of the speakers for 3-4 years now. So every time I turn out to this event, I find something which is very interesting. Last year we had something on fintech evolution a couple of years back. So last year was more on AI and all. Now this year is going to be on different topics. So my best compliments to the organizers for having something which is very educative, and there's a very strong takeaways for the audience as well. So I heard the comparer introducing all the three. These three of us have been the veterans in their own fields, especially Mr. Ramesh. So he's been the Chief General Manager for State Bank and then went on to become an entrepreneur. Truly speaking, in finance business, he was pioneers in starting an affordable housing finance company. So very strong, rooted, deep knowledge with respect to dealing with small customers. And I'm sure he's one of the guys who will be able to throw a lot of insights on the current topic. Followed by Mr. Vivek Kannan, a person who is today running a fastest growing housing finance company. And I'm also running a housing finance company. So we have married to each other as a co-lending partners. So we have first-hand idea about what co-lending is with respect to housing finance companies. So Vivek being here is very fortunate. Mr. Mukesh, who comes from peer-to-peer lending, we term co-lending and all that from a regulatory jargons, but he's been doing a larger co-lending by collecting monies from individuals and lending to other individuals. So he himself has been practicing co-lending for long. And Mr. Krishna Swami from Aptus, while we have somebody who is the fastest growing housing finance company's chief, we also have a technological officer from a company which is highly valued, the most valued housing finance companies, the champions in the category. So a guy coming from that fraternity with that pedigree is also going to be of great help. So given my role today, I will try to be a traffic cop. So try to regulate traffic viewpoints and see that somebody don't exceed or somebody, so everybody gets equal opportunities, including the audience here. So that's going to be my role, relatively a easier role. So before I start taking some questions and putting certain requests for views, I thought I'll give you a broad perspective for a lot of techie guys who come on what is co-lending. So co-lending is a business practice where there are two lenders to cater to one single customer. For an example, there's a customer whose requirement is to buy a home or to buy a vehicle or buy any asset, and there's a loan requirement. Two lenders come together, participate at the risk, and then lend jointly. So there will be a service provider and there will be a secondary lender or called a principal who jointly lends to a customer at some defined ratios. So one of the financiers, say example, State Bank will contribute 80%, a finance company like me will contribute 20%, add them together, we lend to the customer, start collecting and have some predetermined sharing arrangement of interest. So that's what is the co-lending which is taking place. So why is it now very prevalent is because we don't have State Bank of India or the leading banks at every single milestone of this country. So at Tier 4, Tier 3, Tier 2, you might possibly have very limited financiers. Now that we have some arrangements, a small financier can represent, who will bring the reach on the table, and the financiers will bring, the banks like SBI and other large financiers will bring the capability on table. So put together, there is a delivery of excellent financial services to a small time customer. In other words, connecting a large bank and a small customer is what the co-lending mechanism is going to do. So that's been relatively successful, and this has been happening for quite some time. It's not that we are talking something which is very new. This has been happening for 20-25 years, but there are not great regulatory frameworks around it. So there was a lot of misconceptions. The fair practices code were violated. I heard somebody saying about talk customers language. I had the CGM of NABARD saying that transparency levels and all that was not adequate. Now that a framework has started to come, we will find financiers complying to certain levels of circulars and policies, which will possibly help the customer to benefit in large. So that's the whole idea. So with this given idea, I would first of all request Mr. Ramesh sir, the senior among us, to throw his lights on the opportunities which are available in the market, both for financiers, I'm sure for the technological folks here, and for the customer. So an overall perspective about what would be the opportunities available while this mechanism of co-lending picks up. Some views about it, sir.
Thank you, Venkatesh. It's a very exciting topic for me, because in the year 2016, when I had actually innovated a housing microfinance company and was working with some new innovations in the rural affordable housing finance area, I got this idea why a small NBFC cannot work with a larger institution. And I approached State Bank of India and said that you will not be able to reach out to the last mile in the rural areas. I have the capabilities and a model to have a sustainable outreach in the deep rural heartland of India, and to be able to generate small ticket loans to a segment which is very much unserved and underserved and which needs this badly. Can we not collaborate? That was an idea which immediately sparked a very positive response from the then chairman Arundhati Bhattacharya, with whom I had worked in the past, and so we had a good chemistry. And then we worked together actually on a model of co-lending with a 50% risk sharing at that time. And we had worked out the entire framework of how it would work together, how the joint disbursement would happen, how we would collect the money, what would be the respective responsibilities and roles, and how the MIS would be generated, joint MIS, and it would be shared on a weekly and monthly basis. All this we had worked out, and the money was to be provided by the bank, and which is like money on tap for a small HFC like me. So that was a very exciting framework that we had developed. Unfortunately, because of certain internal reasons in our company where there were some differences with the investors, and so I stepped back from the company's operations. And the bank said no, because the whole idea of not only the housing microfinance company, but also this idea is something that we have worked together based on your background and experience and credibility. So we would not like to really go ahead with this. So that was dropped. And I was very surprised or happy. A few years later, the Reserve Bank of India came up with a co-lending guideline first, and then of course modified it subsequently. So this, so I can say that somewhere I have been part of the thought process of the co-lending origination. Now, now coming to why co-lending excited me or why it is important. I think in a country like India, we must accept and admit that 65 or 60, at least 60% of the country's liquidity reserves are actually resting with the public sector banking system. So, for any effective delivery of credit to the last mile in the country, these banks will necessarily have to play a part. But we all know, because of the size, because of certain technology related constraints, certain operational constraints, they are not the best when you come to the last mile delivery of any kind of financial product. So, in this situation, they need a complementary entity which would be able to take care of creating that agility and that outreach, which is the area of weakness or handicap for the large banking institutions. And so, in a country like India, the co-lending model becomes very, very relevant, because where a large institution, a bank, let's say, can join with a NBFC, which is relatively smaller, relatively capital and finance constrained compared to the banks. If these two can join together and complement their respective strengths, then the system becomes much more effective, much more productive, and it is able to reach out to the last unserved client who's waiting for his loans. So, in India, particularly, I think this is a great model to work with, where the banks have the efficiency of distribution and outreach and ability to more productively use their capital and create a portfolio which gives them a steady ROI. And the NBFCs are able to scale up their outreach without worrying about the funding or the asset liability management or even the capital constraints in terms of capital ratios, etc., capital adequacy to be kept for reaching such scales. So, this becomes a perfect match, and in the result, what happens? There is standardization of practices, because there are two regulated entities which are joining together. There is standardization of the process. There is greater governance control, because a very large, highly regulated banking entity is one of the partners. Then you have more customer care consciousness because of the burden of that which is being imposed by or really enforced by the regulators more on the larger entities. And the same standards become applicable for the smaller entities lending also. So, all these together, and to this you add the risk governance, the risk management governance. You have a very large entity with very strong risk management practices and parameters, and it is partnering with a smaller entity which may not have such sophisticated and such well-developed risk management practices. And then when they lend together, even if it is a small loan, the highly evolved risk management practices necessarily have to be applied, and to that extent, the risk governance improves very significantly. So, they are reinforcing each other really in their strengths, and that's why I think in India, the co-lending model is going to be very good. And on top of that, add the cherry to the cake. You have a well and fast developing fintech ecosystem in India, which is creating a lot of efficiency in terms of scalability and in terms of last mile innovations. And if this scalability and the outreach capabilities can be further added to this partnership of banks and NBFCs, I think the result would be outstanding, and we would have the best delivery systems for credit and payment services in the world. And from the fintech point of view, they would be able to prove their relevance and their scalability and utility in joining this partnership of banks and NBFCs. So, I think this is why we have the greatest opportunity for co-lending.
Thank you, Ramesh sir. And one more opportunity for the techie fellows here is that not many of the software providers has got a ready-made co-lending platform till date. We have been talking to a lot of people, but it's like trying to book the principal's portion of loan in their system and to book the second lender's part of the loan in their book, and there is an Excel which gets matched. So there's a reconciliation effort and a process which goes wrong. And I'm yet to see a software or at least hear somebody where there's a co-lending platform where two of us can come in, operate together, get a disbursement done. So there's a huge opportunities for the technological companies here, so that you can develop something and it's going to be a straight takeaway, more on a SaaS model and all. You have something to say, sir?
Come to Monexo.
Huh?
I'll give you the technology. I have that.
Yeah, okay. I'll come to that. So good that he has got something here. We will also hear from him. And while Mr. Ramesh sir was talking about the benefits and all, the new one is that most of the banks and most of the finance companies have stopped lending to NBFCs because they are not rated, they are not adequately rated. Today, the minimum rating expected by an NBFC is going to be A negative or something. So, a lot of NBFCs or good NBFCs have not reached that stage, because to reach a kind of a rating, you need to have huge net worth, and that's going to take some time. So, they are in the progress or in the process of getting higher ratings, but till such time, you need to have a lending platform, a strong backing like SBI or from Hinduja or from Aptus should really not be lending to a small finance companies who in turn will lend. So there's another opportunity which is emerging because of strong regulatory practices and all. So for an example, in my case, we are just a 50 crore net worth company. Even if a credit rating agency wants to give me a higher rating, I wouldn't be able to get a higher rating beyond, say, BBB minus or a BBB plus. And today, till last week circulars and all that, I think most of the banks is not going to lend me. Now, what do I do now? So, I have a workforce, I have 20 branches, I have a huge opportunity, I have identified a catchment to lend. So, what do? I go back to strong lenders, highly rated companies, take money, participate with them on risk, and then lend. So, this is going to be a order of the day. So, what we are going to talk as an opportunity is going to be a way of life. It's going to be a necessity, because the small lenders are going to disappear or will have to force themselves to get into some partnership programs. This is going to be a rule. Now that it's going to be a rule, there is going to be opportunities and there's going to be challenges as well. So, we have Vivek, who's got a very strong experience on risk management. I've seen this market, this industry going up and down for almost 2 decades. So, he will possibly give his views on the challenges which is parallelly emerging while we have such an opportunity with us.
Thanks, Venki. And as Ramesh sir and you mentioned, Venki, the challenges come from the opportunity itself. I would say that there are 3 levels of challenges, and the first is what Venki alluded to, wherein we do not have a technology which is readily capable of handling co-lending as a program. And we've gone through all loan origination software providers. Between me and Venki, we researched the market. Mukesh, if you have a software but you're not out there in the market, that's also an issue, right? But the challenge here is essentially this. You have a customer who gets mirrored on 2 entities' books. How do you ensure that you have absolute overlap of technology? How do the workflows get integrated? Because from a customer perspective, here there's an organization which has got capital and another organization which has got distribution. From a front-end perspective, from a distribution perspective, the customer sees only one individual. All the other tie-ups are done at a corporate level or at the back end. How do you ensure a seamless experience to the customer across 2 organizations, and how do the technology overlay happen is the biggest challenge that one has. Fortunately, in our tie-up with Aham, we have been able to override that because there was similarity in technology. But data structures could be different, the data flow the technology could be different, workflow integrations could be very different, models itself could be different between both organizations. So how do you integrate technology across both the organizations for a seamless customer experience is the first operational challenge. The second operational challenge is at the beginning itself, which is the meeting of the minds, defining the target segment. There is somebody with capital and there is somebody with distribution. Obviously, the ends may not meet, right? So how do you arrive at what is a common minimum criteria for your target segment? For the capital provider, it's about returns, it's about profitability metrics and risk metrics. For the distribution team, it's about aligning their team towards a target segment which the capital provider needs. And that may be quite different or could be a subset of the larger target segment that the distribution company would have had. So how do you arrive at the target segment? And in any of these businesses, Ramesh sir was telling, when you go deeper down or lower down the ticket size, you will not be able to get templated underwriting or templated customer onboarding. You will have customer characteristics. And those characteristics need to fall within the risk appetite of the capital providing organization. And the distribution company should have absolute clarity in terms of what is the target segment that is going to be sourced. Because post sourcing a customer, you can't sit and debate on whether to lend money or not and give money or not, because that's where most of the relationships become unraveled. So that's the second challenge. The third is at scale. When things are good, financial reconciliation is very easy. But at scale, there will be a certain amount of delinquency. There will be a certain amount of customers who go bad. That's part of retail lending. At that point in time, how do the roles and responsibilities play out? As Ramesh sir was telling, and part of the reason why I think the SBI relationship would not have gone through was because Ramesh sir withdrew. Because it's a very people-driven, trust-driven relationship which happens, because financial reconciliation, you may ring-fence it with a lot of theoretical frameworks, but end of the day, organizations have to trust each other. Because if a customer were to go belly up, for whatever reasons, the financial reconciliation of the cash flows, the waterfalls to be adhered to, will require both organizations to have an approach of transparency and partnership. And that's the third level of operational challenges. But as Venki mentioned, if there be a system which can help us tide over the technology aspect, the rest are then downstream impacts which can get managed through partnerships and through the true spirit. Because end of the day, it's a win-win for all three, right? Customer, the distribution-based company, and the capital providing company. But the technology integration and the technology challenge is the key one, which then needs to get, once that happens in the financial module, I presume will follow an onboarding module and then a receivable module for collections. So across the board, an onboarding LOS for co-lending, I think is the need of the hour if organizations have to scale their co-lending partnerships. Feel free to add.
Thank you, Vivek. See, one more interesting thing is that I think in 2013-14, when I used to be for S-Bank, we did a same program in the name of joint lending. We never coined a name called co-lending and all that. Regulators' mind about this was very minimum. So we did something with DHFL. I don't know if Vivek, you would remember, we did a joint lending program with S-Bank and DHFL coming together. And we bought a portfolio and we shared the risk around it. The capital was distributed and all that. It was housed at DHFL. We were, S-Bank used to have a month on waterfall basis, more like a DA. It was appearing that we are circumventing direct assignment process and all that. Anyway, DA is a different subject. Then the regulator asked me in particular when there was an inspection saying that, what is this you have done? So he told, what is this? Is it a program? What is this you have done? He was having no clue about what we have done, but we thought we have innovated something and we did that. Then he started writing saying that this has to be immediately reversed and all that. The one transaction with the exactly 10 years back what was asked to be reversed or to be undone is now becoming a rule or is becoming a new opportunity. So that's all. So now lot of technological companies would be waiting for the regulators to come up with some framework, because you develop something and then finally regulator has got a different viewpoint, then the product itself will have to change altogether. Yeah. You're saying something?
Venki, to add another point, I think in some form and shape, and Mukesh, you would relate to this. Citibank had tie-ups in the commercial vehicle segment with a lot of NBFCs in the past. And because of lack of rules around what has to be done, I think there have been some very bad experiences in the past in the co-lending space. So when we look at new proposals, all of us are board-governed organizations, the scars of the past still remain. And that's another big hurdle in getting things approved and to move around, because unless they see resolution to those issues which had happened at that time, and those have to be systemically embedded, the executive sponsorship required to scale up these kind of partnership is something which people like you and me will have to keep going and evangelizing at various points in time.
Yeah, true, very true. So now that there's a regulator guidance is available, and now that it's become an order of the day, now this is going to be the way lending business is going to happen in, say, possibly at 400, 500 kilometers away from Chennai or any other village, rural, town panchayat. This is the way the business is going to happen. Having this, then I think the technological guys will have to really speed up. And there's somebody who's claiming that he's got a product ready. So we will hear from Mukesh, Bubna, founder, managing director, CEO for Monexo. And he comes from a peer-to-peer lending program. It's again an advanced version. You're 10 years ahead of this co-lending that we're talking. So we'll hear from him and then come to the next speaker.
Thank you. Peer-to-peer lending is nothing new. We give money to each other as friends. If you go to aluminum market, people lend to the aluminum guys. You go to diamond market, one merchant gives money to the other merchant. Happens all the time. But peer-to-peer lending started sometime back in 2004 in UK on a technology platform. Just think of Uber, right? Uber started similar time. You could call a cab. Now you can imagine you can invest in consumer loans at a ticket size of 100 rupees. So if you have 10 lakh rupees, you can put that in, and we are RBI regulated, so we had to go for a licensing. We've been licensed. But we built a platform where consumers like you, individuals like you, savers like you, can come to our platform and invest in these loans at 100 rupees a loan. It's not that the borrower is taking 100 rupees. He may be taking 30 to 40,000 rupees itself, but it's crowd-funded by individuals. And we do everything else: technology, origination, collection, reconciliation, if required, follow-up for non-repayment. Everything is our responsibility. The only thing is risk is yours, reward is yours. We are only a service provider. So in a way, we brought co-lending. You can use the word securitization, direct assignment, whatever you can think of on day one with the consumers. I remember when I joined early 90s Citibank, we did one test transaction for liquidity purposes of about 30-35 crores of securitization. It was a word which was not heard till that time in early 90s in India. First, no legal framework, no regulatory framework was available that time. But being a US company, we were asked to create one as a test transaction and run through it. Let's see what happens. So we created a paper, we got it rated. Then we started marketing it. Nobody had heard about it. It was a good paper. And that time, the yield on that securitization paper was 22%. 22%. Nobody wanted to touch it. It took us almost 12 months to sell that paper. Who bought it? Few family like Hindujas bought it. Right? Now just imagine that's what this peer-to-peer lending has done. It's taken that securitization out and given the power back to you to be participating in the loans. So it's co-lending. As I said, not one loan of on our platform is funded by one individual. It's co-lended by hundreds of individual lenders on our platform. So that's why I said we are tech ready. We've been ready from 2018. The only sad part which we have a request to the regulator is open this up for institutions also to participate on our platform. Today, regulators have capped us at 50 lakh rupees per individual. So if any of you also wanted to put 5 crores on our platform, you cannot do so. And in our business of money is our raw material. Without raw material, we can only grow that much, right? So co-lending is the future. Everybody will agree to it. It's the raw material for the whole NBFC industry. RBI will get worried about few things here and there. It's increased the CAR on unsecured loan recently. But those concerns are valid, but India is changing. Unsecured loan is the first thing which most people will take as India gets younger and younger. The demographic dividend does not come only one way, it will come the other way also. People will take loans. At the age of 21 or 22, I don't have gold. I don't have land to give. I don't have a housing loan need. I have a small need to do a separate education course, right? So co-lending is the way, in my view, and technology will evolve very, very quickly. I'm quite sure a lot of people are solving for it as we speak.
Yeah. Thank you, Mukesh ji. And one more piece of information while you were saying on regulatories, cappings and all that, this co-lending and the learning that I had this morning, I think the deposit taking NBFCs are forbidden from having a co-lending arrangement and all that. Therefore, because that's a deposits, the other side and the priority resetting might have to happen. Therefore, that could be one possible reason why you having a cap on 50 lakh rupees of single entity being on this. But anyway, you spoke about Uberizing the lending business and all. Now, I will ask, request rather, Krishna Swami, the Chief Technical Officer of Aptus Value Housing Finance, to educate the group on the technological advancement that you have. How much of co-lending ready from an IT perspective in your company, or in general views on what the technological requirements that you may have, frameworks?
Let me be very frank, from our company perspective, probably we are not into the co-lending space actually yet. So we did evaluate with few things. Here we were speaking about products which will complement a bigger NBFC or a bank along with a smaller NBFC or something. See, what I see or where I see as an opportunity is, from a technology perspective, is a bigger NBFC tying up with a fintech company or a company which is completely technology focused and technology based lending actually, where the products are different. The larger NBFC will be catering different product, while as this young fintech company will be evaluating or bringing in a product which is completely different to what this NBFC's principal lending practice is basically. So this will complement both the companies, and it also will bring in a lot of futuristic and a forward looking approach to the bigger and a larger NBFC basically. Okay, because we did an evaluation on that, and there are a lot of organizations or fintech companies specifically in this space which are doing that. And today, if you see, as we all know, that what UPI has brought in the last couple of years actually, it is a 16 lakh crore market. I don't know how many people realize here that actually. It is a 16 lakh crore market which is available for lenders to evaluate, do a credit assessment, evolve models around that, and lend to customers based on that. So here I would say few things from a technology perspective, whether it is KYC, whether it is understanding the demographics, the family, the business profiles, multiple preference. All this can be done through a technological approach today, based on models, different scoring models we can have. You can assign weightages to each of this aspect of the customer and understand what is the customer's risk ratio or the default ratio basically, or what is the likelihood, his intentions. Everything can be assessed through today using a lot of models basically. In this UPI credit actually will make a huge difference, where there are organizations, there are fintech companies which are there, and there is also a lab being set up in IIT Bombay especially for this, on how to go forward and bring in new changes actually, new ways of lending to the people who are doing this. Today, this UPI credit based evaluation becomes very much easy. The mandate collection also becomes UPI mandate. So the loan origination is through identification of digital platforms, and then the credit assessment happens seamlessly through various scoring models and machine learning models, and understanding the customer behavioral models in the market, and also the UPI credits into his systems and how he is getting paid by his end users and how he is paying to the vendors basically. Okay, this can be assessed very easily and in a very transparent way, and the collection also happens through an UPI mandate. And this is a loan which periodically needs. Once he becomes a customer, he comes back to you very frequently. It is not a one-time loan like most of the traditional NBFCs do, where your customer journey is there for 7 years or 10 years basically. This is a loan where your customer journey is there for 1.5 years or some 500 days or something like that. And again, he is going to become your customer based on the customer experience you provide. Okay. So this whole space of co-lending along with fintech, which needs to be looked forward, where complementing products can be also be looked in. Where Venki, he spoke about, the bigger NBFCs supporting him in his traditional loan products. Apart from that, there are products which can be looked forward also, where it is completely technology based.
Yeah. Thank you, Swami. One more small clarification is that, see, when you experiment something, you experiment it with the most standard product or a most risk averse or a low risk product. So housing finance in our case, and in all the asset classes that we have, housing loans is considered to be the most, very low on risk, safest. Therefore, co-lending to start with, we started with a product which has got some stability and all that. But over a period, it gets relaxed and then it gets extended to the gold loans of the world and the personal loans and unsecured loans and all that. So that's going to happen any which ways. See, now I really want to talk, since Ramesh comes from a strong risk management background. Say me being a small NBFCs, and I am present in a very small geography, so I understand a micro market much better than a larger company. I understand the regional flavors in the market. Suppose if I have to give you an example, there is a market called Shangagiri in Salem. Maybe the State Bank of India chairman may not know that there's a market existing called Shangagiri. So I may have a risk appetite to operate that market. But a larger entity like you or like Hinduja or like many other companies that we have, they may not understand it to the same length that what I understand. So they might have a strategic relationship with me, but at the execution level, there might be a mismatch. So what do you think, sir? I'm now asking you as a financier, what do you think that I should go and propose to, say, Hindujas for that matter, saying that, boss, I have a larger risk appetite. I can't go and tell that I understand this business better than you. So possibly in a very glorified way, I can tell that I'm here to take more risk. Why don't you participate with me? So what should be my pitch? Or in other words, what should be a risk management which will be common for both? Right. A framework or some go-to-market strategy. Any English to that you can say. Yeah.
Very, very interesting, thought-provoking question. Yeah, probably I will put on my SBI hat for some time and then look at it from that point of view. So, from a risk management point of view, whenever any entity is going into lending, it has its own set of risk management policies and guidelines and certain parameters based on which it does. The parameters may relate to geography in terms of geographic exposure limits. It may relate to market segment related limits. It may relate to micro area related exposure limits. So, lot of these factors will be there in large organizations framework of lending. But when it comes to a co-lending and with a smaller entity and which is more focused on a micro area, I think this poses a new challenge to the current risk management approach of the larger entities as such. They will need to modify the risk management frameworks to be able to look at micro area based exposure parameters. For example, you in Shangagiri, here you have a good, thorough understanding with your feet on the ground. So you may say, okay, if there are, say, 20 villages comprising this cluster, I can cover all the 20 villages successfully. And I can cover maybe 75% of the borrowers in each one. Now, from a larger entity point of view, this may look like saturation over exposure in a limited area. So, I think this is a completely new area where we have to develop frameworks, keeping in mind the fact that in a micro area also, if basic selection parameters are accepted, whether it is in terms of bureau scores, whether it is in terms of a profile and a scoring of your own, which you have mutually agreed upon. So it is very important to have a mutually agreed set of parameters relating to, and create a scoring model. Then it becomes easier that as long as it comes into the score, I'm not worried about.
So we agree on what Vivek said earlier, that we'll agree on some common criteria where we'll have a customer which is good for both of us. So that's something which is understood. But again, sir, there's a very strong urgency. Again, on the risk management angle, I want to highlight a very strong urgency when two lenders lend, and there's a customer who's going to deal with me because I represent both of them. The customer, with all possibilities, would have paid me, but I would have not paid the earlier fellow, my principal. So I might take it, we call in a local language, rotate it. We rotate it, or we try to diversify it, we use it somewhere else, and then come back, because you are not going to ask me, the bigger lender, the joint lender is not going to ask me till the time it turns NPA, or till the time there's going to be a default of some triggers and all that. So if there's going to be a system where the mirroring happens, like what Vivek tells, or if there's going to be an UPI payment like what Krishna Swami says, that there's an equal split from the day one, for which there's a technological need. Till the time a technological solution is not available, this co-lending, for all you may mean, might remain only as a framework. It may not even take off. Because everybody is afraid what is that he is going to collect, because the communication is not standard.
I agree a lot, because here I would like to add a few points. I think this is very, very critical. Why, even though the ecosystem or environment seems to be very favorable for co-lending, why it has not taken off so far? I think this is a very key reason for that. See, the RBI also says in its regulatory guidelines that you can have two models. One is where you accept the portfolio as it is, or you can cherry pick the model 2. But in the first model, which is more popular and which would be probably more acceptable, when you take it, when you say you will accept the entire sourcing that has been done by the co-lending smaller partner, you are also enjoined to do a pre-screening of the entire thing. How does that pre-screening happen? It is very, very difficult practically to do it unless you have a good platform, a technology platform, where all the data parameters are visible simultaneously to both the lenders, and then they are able to do that. This is where again it differs very significantly from your P2P kind of co-lending, where on the co-lender there is no obligation that he has to do eKYC. There is no obligation that he has to do a creditworthiness check, each co-lender who is coming in your platform as a co-lender. But in this co-lending model, every single co-lender has to do that. So the platform has to be very different and very much deeper and more complex to be able to take care of all of these things and simultaneously, so that you don't have duplication of two such activities happening each time, and then the benefit of the efficiency and speed are lost.
Yeah. Lastly, one minute, Mukesh. See, the one more thing is that we spoke about opportunity, risk management, but one practical thing that I want to ask Mr. Vivek, now because he runs a business and franchisee which is spread across 21 states, 2,500 locations, 100 branches, should be around some few lakhs of customers and all that. But you will have a strong learning from all these markets and all that. And I'm sure you have a scorecard. Since I'm aware, I think I can ask you a very relevant question, but you have a scorecard, you're able to judge the risk at each of the markets and all that. Should you then come with a paper? And if that paper is going to come, what would be your top 3 items in it, as a co-lending partner like me and a technological person? What should be the minimum that you are talking about? So that with that large experience, we would at least focus on those markets, on those segments, whatnot, all the elements of lending. What is the top 3 that you would advise us?
I think, and most of it has been addressed by Ramesh sir. It's a derivative of the same. One is, across the country, we can't be one size fits all everywhere, right? So the co-lending partnership obviously are dependent on entity like Aham being very, very strong in customer identification, in customer onboarding and market penetration in certain areas where Hindujas may be present but may not have the same local capability as you. So one of the first things that we would want to bring to table is complementary abilities. One do not want to cannibalize the distribution of both the companies, and that's the basic premise on which the partnership should begin. That there is value add from both sides to each other and not just about capital deployment and distribution. That's one. Second, we should be able to identify the areas which are no-go. So we should be able to classify boundary selling as Ramesh sir mentioned, if there is a specific place or a micro market and that micro market is say dominated by a certain set of people and we feel that beyond a certain level of exposure there is risk, then we should be able to define that in quantitative terms, selling in a specific district or a specific town or a specific area. This is the level of penetration or exposure that we will define so that there's clarity to the partner on what kind of human capital deployment can happen. I mean, one of the elements that we forget here is the human element. As I told, two organizations can sit across a table. I and Venki can sit across a room, have a cup of coffee and agree on 10 things. But the guy in Pudukottai or the guy in Nagarkovil who goes on field and meets the customer, we need to make life easier for him and we need to make it easier. So, and understand, second item will be the understanding on what boundaries have to be the boundary constraints and within that what can happen. And the third point, and as you rightly mentioned, is how do we look at customer cash flows and what frequency and what modality we look at and what arrangement we do for that. I think the last point is the most important and that's where trust breaks down. And that's where, unfortunately, between us, the trust is very high, so we don't have that issue. But many of the other relationships have broken down because there has been perceived areas where, and many of them may not be true also, but there have been perceived areas of breakage of trust, which has led to the partnerships going on. So three top things. One, complementary skill sets, where we bring value add to each other. And more importantly, the distribution partner adds value to the capital provider. A clear understanding of what to be done and what not to be done. So what not to be done more importantly, so that we know the boundary areas and make life simpler. And the third is how do we look at the financial reconciliation on a regular basis and agree on what modality that would take. I think these are the top three items that we would bring to the table, Venki, in terms of evaluating a partnership.
Yeah. Mukesh, quickly.
This is going to your previous question. When the repayment is collected and you can misuse it. I think in the P2P framework, we have seen escrow account being one of the mechanisms. I think in co-lending also, that should be adopted.
Yeah, it's compulsory.
Yeah, it's compulsory. So that should avoid the issue. Second point, again, I'm not sure, but in a co-lending also, only one person has to do the KYC. And that, again, unfortunately in India, KYC is such a vast topic. Every bank does it differently. We done CKYC, but it's not good enough. We've gone through major evolution. But with technology, with video KYC, SKYC coming through, and I was just reading today, some new fintech has launched low bandwidth SKYC, video KYC, so which you can implement in the rural market also. Those adoptions will really help in driving the efficiency at the ground level.
Mukesh, I think what Sir was mentioning is it is incumbent on both the organizations to have our customers on their books. Hence, the KYC done by the onboarding organization should meet the KYC standards of the capital provider organization, because the audit guidelines could be very different for banks versus for NBFCs. Fortunately, most of India is moving into digital KYC evaluation. There's a standardization happening there. But where I think Sir was coming from was the fact that in the absence of standardization, this can be a point of divergence between two organizations.
Yeah, the one more interesting thing is, for a 3-page RBI policy, we have spoken, 5 of us, for almost 35-40 minutes. So there are a lot of areas which is now, on a best practice, you imbibe into it. So there's nothing written. It's a 5-paragraph circular which has come, or maybe 6-paragraph circular which has come. On 6-paragraph circular, everything has been broadly suggested. So from there, whatever we are able to interpret, we are doing it. But again, we say it's conditions applied. So we are talking on best of knowledge basis. So lastly, when we wind up, and maybe we'll have one question from the audience, for any of the panelists. Before we take that, I saw you. I'll put the question. I'll give you the opportunity to ask the question. Meanwhile, as the only technological head here among the panelists, what is that you would like to advise all of us, including the audience, with respect to what should be the approach on the roadmap for the technological person to effectively implement a co-lending practice?
Yes, today I think most of the products which are being used by any of the NBFCs has a lead management as a practice, and how the lead flows right from multiple channels into until the disbursement, or until even the books, until the trial balance, or whatever it is basically. So there is a full journey of the customer which is captured here. See, in a co-lending practice, if you and your partner, whoever is the co-lending partner, you agree on a journey of a customer, it is very important actually as a technology perspective, you bring in a plugin where it goes through this complete journey. Okay, whether the KYC, he says that, okay, the KYC, does it match to the parent organization, or whether the credit assessment matches to the agreed terms or something. These rules can be written along the journey, because the journey is the same. The journey is to lend, right from a lead to disbursement. The journey is not going to be different. Maybe the flavor is different actually. So you have to bring in a plugin where you have the typical, where you bring in right from the KYC, what is this is agreed upon for this co-lending practice? What is the credit norms which are agreed upon for this co-lending practice? What are the other parameters, like for the payment request to be raised, or a basic health check to be done, or whatever integrations need to be done, whether it's a digital agreement, whether it is an account aggregator, basic hygiene check actually of the customers. These parameters once agreed and rules are evolved across the journey, once a plugin is brought, and then the disbursement can happen to the customer account. So this will make it very simple. The same lead management, omni-channel journey of the customer can be brought in as a plugin into the co-lending practice also, which on the agreed norms and terms and hygiene factors and the credit factors, and also the technical assessments or whatever the factors can be brought in, and disbursement can be done.
Yes, sir. Yeah. Thank you, Krishna Swami. Yeah, that question from the audience.
It's not a question. That NBFCs and banks are looking for a technology solution, and I believe that unless we have that framework ready for any technology provider, building a solution that caters to those needs would be very, very difficult. And the reason I'm saying that you all as lenders, either a bank or an NBFC, do understand lending one single loan in your current legacy application. Now imagine a same loan having 3 images to be maintained across 3 different systems. And I'll tell you operational challenges. Let me take one example. In a happy flow, a customer pays and you have a split, and then you keep paying the money. Imagine in an operational situation, you have to cancel that loan. How do you inform the bank? How do you maintain that book? All your reports that you've built over the years, and these would be thousands. I mean, for a large size NBFC or a bank, every report has to be changed. You cannot show the same income, which is the image of the customer. You have to minus the portion of the bank that is funding it. Imagine a situation you have, and these things do happen. You have a loan that gets terminated, right? After a while, you realize that the payment was not for that particular loan. It was something else. You have to reverse the loan. How do you inform the bank? So unless the industry sits together and draws a framework of how every step in that operational flow would happen, finding a right technology would never ever come in. I mean, everybody would give you a half-cooked solution, and that half-cooked solution would mean that you will always have reconciliation challenge, and you'll always find something to blame to the technology provider that you've not given us the right solution. So my request to everyone over here is that together with RBI, the industry leaders should sit together, draw a process map for every flow that happens in a loan life cycle in a co-lending space. And once that is there, I'm sure each one of the technology providers who are sitting in this room would be able to build a solution in 2 months' time.
What is the question?
So, I mean, there's no question. I mean, this is just a suggestion that we would not be able to find a technology solution until we have the framework ready in a transparent way.
Yeah.
Now, I am speaking not as an educated person. I am asking a question as an illiterate tribal woman from the remotest of the area in India. What she has in mind. Now, co-lending means bank and an NBFC. Her question as a tribal woman who knows nothing about a bank, who doesn't know even what NBFC is, if she goes for a loan and she finds out, just I'm asking a question for many people also this. NBFC and bank, who will benefit the most in a co-lending, and who will benefit the most, or are they complementary to each other? That is the question I want to know, and how will you answer to a tribal woman? Thank you.
So if I may take that, I think in this scenario, the customer or the tribal woman that you talked about is a winner. And I'll tell you why. If you are a tribal woman and you want a certain loan, whatever may be the nature of the loan, you have an organization which is reached out to you, which is able to lend to you, but not at a rate which is affordable to you. You have an organization which has got the capital, which is unable to reach you. Co-lending is a perfect platform designed for you to get what you need at the rate which is most suited for you. So the winner here essentially is the customer. Yeah, and what do you see as you see that if, for example, Hinduja Housing Finance is tied up with, say, Bank of Baroda, and the Hinduja finance person has reached out to you. You see Hinduja Finance. But if you see Hinduja Finance on its own, you will see probably for an unsecured loan, 22% rate of interest. If you see Hinduja Finance in the co-lending avatar and you are impervious to that, you will see the organization able to lend you at, say, 14.5%. The benefit is to the customer. That's the basic premise of co-lending. The winner in this is eventually the customer if done the right way.
Very good, I like that.
Yeah, madam, if I can add some more. If I can add some more. See, one, the ultimate winner is the customer, but you have other infinite winners here. As a small NBFC, I am also a winner because I would have got restricted capital. I would have never thought about lending to this tribal woman. Now that I have a capital inflow to me and I have a cost benefit which I can pass on to you, my borrowing cost would have been at 15, 16, example. Since because I got it at 10% from Hinduja, I pass it on to you at 16%, which is my borrowing cost. So your cost of borrowing has come down. You have got a cheaper loan. In the process of you getting a cheaper loan, I made my margins as well. So I am also a winner. Now you look at the lender has got one more customer. Otherwise, what Mr. He would have never reached you. Now he has got one more customer on his book, and he is going to understand you better over the period of you staying with as a loan contract, and there could all possibilities be a there can be a straight lending to you next time. So you become a bank customer next time, and he gets one more customer next time. So he need not be lending only to the MRFs of the world, only to the corporates of the world, and retail lending is the most safest lending today. So he gets into diversification. So it's an infinite winners in this way of doing it, and possibly.
One more thing, actually, see, when it comes to the question of tribal women, what you're talking about, there is a marketplace available, okay, where like big players are there, Amazon is there, a lot of players are there, and apart from the government is also has come up with a platform, okay, where the products they make or whatever the capital needs are taken care of actually at a very, very reasonable prices actually, rates. And this will also help them in creating a digital footprint for their individual loan needs also in future basically. That is where the fintech companies come in for it, where they can grab all this information from the marketplace very easily. They do that.
See, we have put only housing finance as a discussion point here, but this can get extended to any product. It could all, get extended for MSME loans, or it can get extended to any product for a peer-to-peer lending, or to a vehicle loan, or to a commercial vehicle loan. It can get extended anywhere. So we have just kept housing loans as one of the, of the context to drive our point. We have done that. So maybe as a last question from my old friend, Chakravarti. No, sir. So can I explain you, sir? Today, I think I'm the smallest lender in the entire floor. I'm the smallest lender, and I'm the youngest lender also. I think there's nobody who's smaller than me in housing finance space. But I'm telling you, I don't have any concerns, or I don't have any reservations of what am I going to do tomorrow. Because last Friday there was a circular coming that only A+ companies, A-rated companies will be accessible for loans from banks. That does not have anything, because I got some 7, 8, 9 partners ready with me. So I'm going to do business as usual. My money is going to be available on top. Just that I may have to share the risk with somebody, profits with somebody. But at the same time, I'm also leveraging my capital. They bring 80, I bring 20. So day one, I leverage 4 times. So my profitabilities are intact. So, and actually speaking, co-lending has removed the uncertainty out of the minds of the small lenders like us. Like I explained, that's the infinite, no, it's a win-win for all. So it's a great opportunity for us, and that's the way forward. So
actually, it's a new avenue for survival of small NBFCs, provided they are efficient at the last mile outreach.
Okay, sir. With last thing, I think I've got 2 indications for us to know Bahubali 2. So at last, sir, but this is one business which is going to be born out of what is ultimately an NBFC's role. It's only a bank's inefficiency, the NBFC's opportunity or business. So that system is always going to be there. So banks cannot reach everywhere. Big financiers cannot virtue of their size, cost of operations, etc. So NBFCs will have to be there. Small financiers will have to be there. There will be regional players, all that. But just that the water flow is going to be slightly different than what it used to be. So with that note, I hand over this to the next session. I don't want to be between your coffee break. Thank you very much, and see you next time.
Thank you. Thank you. Please give them a huge round of applause. I request a moderator for the session, Mr. Venkatesh Kannapan, to present the memento to this panelist. So first, I request sir to present the memento to Mr. Krishna Swami. Please give them a huge round of applause. Next, I request Mr. Venkatesh Kannapan sir to present the memento to Mr. Ramesh Kumar. Next, I request sir to present the memento to Mr. Vivek Kannan. Last but never the least, next I request sir to present the memento to Mr. Mukesh Bubna. So now I request all the panelist members to kindly join for the group photo. Ashish to kindly come on the stage to present the memento to our moderator, Mr. Venkatesh Kannapan.